All right, so this video will be on the price analysis I just did in the Discord. I'm gonna make this one quick since it's already in there and I already did it. But then I'm also going to make another video after this comparing the bear markets of 2022 and the trade war in 2018 to what potentially we have here. That one will be more off the top of my head, and you'll be seeing me do the live analysis when I do that one. But this one, I've already done the analysis, so I'll try to make it quick here. So it's a more bite-sized video compared. So, more or less, we have a good amount of stuff that's happened. Obviously, with all the tariffs and just the uncertainty that this current Trump administration brings to the table, the market is not like that. One thing about Biden's administration is it was extremely predictable. We knew what was going to happen. We knew what they were going to do. Markets like predictability and stability. Right? This 4-week period is the reason why they don't like unpredictability and a lack of stability. We can look here that this is on MNQH 2025. Right, you can see it right here. It's the March 2025 contract. On the March 2025 contract, we can see that we went right off the OTE of the total leg up. So these are the August 2024 lows, and this is the December 2024 highs. So we can see we went right down into the OTE, dipped down a little bit, but then all of a sudden, just nice, good wick down above it. This is bullish in most scenarios. But in something like this, where we've displaced all the way down to OTE, I could see us continuing down to try to sweep this sell side down, or right over here. I could see that happening. But I will put a case out to why I think we will see a short-term bullish pullback. Mainly, this volume imbalance right here. See how this has been open? These are like magnets. Hold on, let me get a magnet. Where you at? There we are. I love this guy. Look at him. This is a magnet. A volume imbalance. A gap. Whatever you want to call it. One of the reasons why I like using futures as a way to chart comparatively to just using the NASDAQ and NDX up here is that the candles are more, well, they book overnight price in the candles, right? You get gaps up, gap down on NDQ or QQQ as they open and close 4:30 and 9:30. Futures are closed for an hour. They continuously go. So gaps on futures are more significant. They play more of a role comparatively to all these gaps. Gaps can be overwhelming and confusing on if you're trying to day trade QQQ with options or whatnot. But gaps on futures are significant and important to look at. So this volume imbalance is extremely important to eventually rebalance. It's going to be a magnet for one, rebalancing, and two, sweeping buy side liquidity. I think they know that they want the market to go lower, therefore buy side liquidity is a huge target, at least in this short term. With price going down to OTE, rejecting it as it did, and closing above the 6.2, again, this entire area in this fib, that's your OTE, optimal trade entry. Treat this as one big area. Any sort of entry within this area is optimal trade entry, and how we react to it is extremely important. Closing above it is extremely important. I marked a 0.5 fib on this wick. Wicks are gaps, remember this. So any sort of significant wick like this is a, that's a 500 point wick right there. So I'm looking at this 0.5 as a potential long entry, but more as a sign of support. I wouldn't use it necessarily as a long entry due to how I'm about to go into the daily, which I'll go here. We can see that we have been just consolidating, and this same fib, it just goes back down into consolidation. And at that point, we could be just going back in. So it might not be the best idea to go long there. Usually it's good, but if you put some premise to it, it doesn't make any sense because you're taking a higher risk trade in the middle of consolidation and the possibility it goes back down and back up and back down. Wait for the breakout. It's important. The only reason why you should be trading consolidation is if you're scalping. You shouldn't be trying to trade the breakout of a consolidation. You're going to catch a lot of heat, and it's going to be extremely difficult to actually time and be on the correct side of things. It's not easy. If you're trading a consolidation, trade the buy side and sell side sweeps within the consolidation. That's going to be the way you're going to play that game. This daily fair value gap right here has been marked. It's important, as we can see that we've been bouncing in between it. We weren't closing above or below. We had wicks go above or below it, but we never closed over it. This last candle on Friday did. That's important. That on top of how we did close above the 6.2 because of this candle, right? You know, the weekly we closed above the 6.2. Price is fractal. We can see it was because of this Friday that we ended up doing so. So it's important to know that this candle is bullish and the reason why it's there. So I look at that and I'm like, all right, cool. This is a bullish type of short-term bullish thinking, right? This is what I like to see if I'm looking for this high time frame pullback here up into this VIM. I guess this is a short term, not a high time frame pullback. I guess it's a short term to this high time frame volume imbalance. So that's important. You can see that option expiration is right here. Yeah, I'll zoom in a little bit more. It's right here. End of the week. It's important to know because then you can't trade this contract past the 21st, nor can you swing it past the 21st. Open interest is still extremely high compared to MNQH. So if you go to, just type in MAQ, you can introduce drop list. Or M, I mean, not H. This is H. MNQM. You compare MNQM, the open interest is only 16,000. You switch contracts when the open interest of the new contract exceeds the old one. It hasn't. This has been booking a little bit more efficiently. See this volume imbalance that we're looking at to trade to isn't here on MNQM. That's important to know. And also, look at this. This data is in here as well, since this is the June contract. There wasn't a lot of volume for the June, so you can see that it just happens like this. You could change the candles to Heiken Ashi up here. Where are they at? There you go. Heiken Ashi over here. You could, but that's an issue. That's a data discrepancy, and it's extremely important to note because next week we'll be trading these MNQM contracts, and that could cause some potential variances in the trades. And I'll go over this as it's important as we look at the NDQ, which is the 100 index. This is what you're tracking. See, you have this gap, right? You have a lot of different gaps, right? Because that's how I was talking at the beginning of this video. But this is the specific volume imbalance that we're looking at on our March expiration contracts, right? This is a volume imbalance here. So this one lines up with our futures contracts. The rest of these, not really, but this one does. This is a significant VIM to close. It's important. Plus, this is a prop block right over here, right? Prop block, prop block. It's a great area if we end up going to short into. But anyways, it's important to know this. So for now, to the end of the week, we're trading MNQH. The open interest is still there. The data is more reliable. We'll deal with the other one when we get to that point. You could also see it on MNQ1. This is the collective of all the contracts, so the rollover. A couple months ago, I believe I was talking to Matt about this, and I marked how you can see that the rollovers. They have them marked here. It's simple, but you can see how there's gaps up simply because of these rollovers. It seems like these gaps are actually pretty good, right? That's why OPEX, option expiration, they every quarter they have these OPEX, and it's really important. There's a bunch of expiration dates, and you can see that it gaps up. Seeing this gap reversal could be a good model. I mean, look at that. Every time. This one didn't go all the way down, but you saw some sort of retracement into the gap. This one was very small. This one was also pretty good, right? So it's important. We'll see how this does. I don't know if it's going to gap up, gap down. I mean, you could see, I guess, technically, but we'll check with this next week because it's important. I guess I check this one. Oh, this one we just... Jeez, I guess the 17th. I mean, look at that. The top of the market was the day that the new contract was rolled over into MAQH. That's interesting. So these expiration days on futures are very important. The contract switch, you can see it. It's from NH to NM, right? It's important. We look at those gaps and we study them, and we understand that each quarterly contract presents different data, or the same data in a different way, right? It's the same idea, right? This is all it is, but it's how the forward curve is taken in. So it's important to understand that. I want to go over that as Friday. That's happening. It's important. So, I guess I'll go back to here, and I'll go over the specific bullish play that I'm looking at. So here's the hourly, right? So here, actually, well, you saw this daily. I guess we'll go back just to make sure you saw it. You highlighted it, blah, blah, blah. Here it is. That's that daily fair value gap that's been holding us down, right? This one has been acting as some sort of support. This one has been acting as resistance. So since we've seen us hold this one, and we've already fallen so hard, I expect some sort of squeeze up to sweep this buy side. Again, this is where we're looking at right here. This closure right here, with this right here, this buy side is a possibility, is really good. But what I'm looking at is something like this. Simple. This is a pretty good low. We're like seeing like something like this, right? That's what we saw. We saw a lightning bolt up. So what I'm hoping is we continue to go up like this. And then we go back down into the CE of this daily fair value gap. I'm very interested in entering in at the CE, this fair value gap. And you can see the wicks have respected it greatly. And that's something that we like to see. So if we do see the CE and we can get an entry, I would love for it to do something like this. This is what I'm really looking at here. I mean, you can see that how price works when it goes in one direction, which is a... Wow, the word is it's falling through my head. I have it marked in here. Displacing. Jeez, took me that long to remember displacement. When it displaces, you can see that price eventually goes back up and retraces up to the point where it first displaced. So, frankly, that's what I'm looking to happen. It rebalances up to this area and up to here. But this is the area that I'm really looking at. This trade specifically, if it manifests, I'm taking without a blink. If I lose on this trade, I don't care. This was a trade that I'm forming. It is under a model, right? We using daily fair value gaps as an inverted fair value gaps as an entry is I've talked about with Matt and everything, and something I've done in the past. It's important. This is up to liquidity, right? At this point, this would be liquidity above these and into this volume imbalance. This case, with one contract, with 477 points, that's about, I'd say, $460. Here, one second. I can show you. Let's see this. I'm going to buy one. It's a buy stop. No, I don't want that. Get out of there. Here you go. As you can see, if it goes all the way to the top, it's $460. That includes, I'm pretty sure that includes your cost of sales. And then if, say, I have this 1 hour fair value gap marked, so maybe I should go below it. That's a $265 potential loss, which is a big loss. I get it. But it's important that you know, would you rather take one big loss and a good trade with a high risk reward, right? In this case, because you're risking a big amount, or just take a bunch of dumb little trades you're trying to scalp, and you end up losing 3 of those trades, and now you're down $300 for doing some random bullshit instead of waiting for one big trade. You know, and this is up to you. If you're not comfortable with taking a 92-point stop loss, only reason why I'm doing that is because of how this market has been moving. These order blocks are insane. Look at this order block right here that I marked down and has been shown to support. Look at how we went down on this 10 a.m. right here. That would have been an amazing trade right there. I mean, but look at that's an 89-point freaking order block before going up close to 350 points. This market is rough. It's tough to trade. It's extremely volatile. You have to be able to take these types of stop losses. You're able to stomach them. Because if I did something like this, or my usual 24 points, come on. I could, this could end up being really good, right? I want to enter a little bit above the CE because the market likes to go right, but like this happens right here. It goes close to it, but it doesn't actually get to it. So you do a little bit above. But if I had like my regular one where this is like a 40 point, 80 points, or $80 stop loss if I'm trading 2 contracts, this isn't enough. It's just going to go through. If it does go down, right, we're hoping that it just does this and that. In the best case scenario, it does that, but it could do something like this where it goes right through it, right? I mean, that's 16 points, but again, it's important. You could maybe have something like a 50-point stop loss. So then it ends up, maybe it breaks through this daily fair value gap and you're like, oh, it broke right through it. That could be something good, right? And then you save yourself from taking a farther loss all the way down here. This is where risk management comes in. And this is a personal trader's opinion on what they want. Some people think that something like this might be safer because if it's going through this daily fair value gap, obviously this daily fair value gap didn't act as support like you were hoping. And since it didn't do that, your entry is now null and void. So holding it down to here would just be losing unnecessary money. But a counter argument is like, well, we've seen it do something like this, where it pokes through and then goes in the direction you want. And you see that happen a lot because this market is extremely volatile. Therefore, I want to keep the extra points on the table as a stop loss and keep my position in. Oh, but you could say counter argument. Oh, you could always re-enter and save that extra money that you could have lost. This is where people butt heads regarding risk management. Personally, I could agree with something like this, where it's a 56-point stop loss, which is 100-something points on a single, $100 on a single contract, which really isn't that bad. The moment you start trading like 2, 3, 4 contracts, and $100 is kind of nothing. 100 points on a 55-point stop loss on a single contract, that's not that bad, right? You get used to it. That could be a good stop loss. This could be something I could be doing, right? And that's the idea. Maybe you could go below the yellow line at the top of at the top of the weekly open that I marked, something like that. But that in a bullish scenario is where I'm looking at. If we can get something like that, we hold in this daily fair value gap. Hopefully don't poke below it. Again, the stop loss is there to protect yourself from losses, but you're not planning for the trade to do it like that. I guess you are because you have a stop loss and it's part of your planning. So I guess you're hoping that the trade doesn't do where your stop loss goes, but you have your stop loss to protect yourself from A, losing money, and B, becoming emotionally attached to the trade. And I guess that's the biggest thing. It's the emotional attachment to trades. You don't want to do that. If the trade is quote unquote invalidated, you want to not be in it anymore. So I guess in the earlier example, the argument between A and B, if 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 your specific entry is no longer valid, why would you want to be in it? Even if you could have a potential that it reverses even lower, who knows? But then you can always re-enter if it ends up sweeping and then it goes up, right? Even if you enter up like here maybe or whatever, like it's still the same point, right? But that's, again, this is where traders differ, and where you have to find your own niche and how you are. It's important to do that. Everyone's different. I can't teach the same thing that I like to you because you're your own person. I mean, for me, one of my biggest issues, like I said, I have my whiteboard to the left of me. My recurring issues. I exit before my stop losses hit because I'm afraid of losing money. This has been becoming better because I'm like, whatever, I'm just going to hold to the stop. The reason why the stop loss is there is because that is where the point the trade becomes invalidated. At any point between that stop loss and my entry is a designated risk area, and it's okay if it goes to that point. So that's my issue, and I guess averaging in too early. But in this case, that's a separate concept of between stop losses and whatnot. Well, this ended up going longer than I thought. I was hoping it was going to be 6 minutes. It's been 21 minutes. This is what I do with this type of stuff. I guess, in the way, if this specific thing doesn't work out, this specific trade doesn't work out, guess what? We'll fall through the floor. And if that happens, let's go look at what happened last time you fell through the floor. If you fall by model number 4 and you enter in a potential order block right up here, if you took a 50% fib on this and entered in right over here, or waited for the order block to happen, and when we go down here, see, it was created, we close below it, you have this little wick right here on the opening of that, and then you hit that, boom, that's it. You just hit short, and you hold on to it, and you make money. That's literally what happened here. What happened over here, what happened over here, what happened over here, and this is where my original stop loss, my original short entry that sparked my current streak was. I sold right there, and I bought back in right there. Obviously you look back, you're like, holy moly, you could have made so much freaking money. But this was like $1,500, and I'm like, yeah, I'm good. I made enough money because being content with enough is good. So I guess I don't know. Maybe I can code the video when I post it on YouTube. I want to talk about the upcoming FOMC meeting, which is on Wednesday at 2 o'clock. The specific FOMC meeting could be extremely important and also extremely dangerous to the market. This meeting is the first since the tariffs have started and the markets have hemorrhaged. The idea of FOMC in the last 2 years has been to constrict policy. They're trying to raise the rates and to slow down the economy. It's quantitative tightening. I guess that's a specific word for it. They're trying to tighten the economy by raising rates, which makes lending more expensive. They have been on track for a soft landing throughout the Joe Biden's presidency. It's been honestly a marvel of economic throughput and just the amalgamation of a bunch of extremely smart individuals' ideas and viewpoints on the economy. It was almost unprecedented, the amount of inflation that we saw and how quick we saw it, and the fact that we almost got it down to 2%, which is their goal. We got it down to what, 2.5, 2.6%? But now Trump comes into the office and ruins all that. These tariffs are paid by the consumer. Don't let anyone else tell you anything else. The tariffs are paid by the consumer. Companies pay more money for the same stuff they were paying for 2 months ago, but now all of a sudden they're paying 25% more for these because they had to import them with an additional tax. This causes prices to be raised. The companies are not going to stomach these costs. That's not how it works. They have investors to appease, and they need to raise revenues to counteract higher expenses. They want to keep the bottom line intact as much as possible. Whether prices rise by that 25% tariff, or maybe they only go up by 10, or even the fact that prices are even going up because of policy that could have been avoided is a catastrophe for that potential soft landing. It's terrible, to just put it bluntly. We were so close, and now the Federal Open Market Committee has to redo their perception on everything. And there's a chance that it is completely out of their hands and it's into the hands of President Trump. And depending on what they say on Wednesday, could factor into a potential stock market crash on Wednesday. If they say anything about a soft landing no longer being possible because of tariffs, the stock market will fall 3% in an hour and a half. Easily. It will be a bloodbath between 2 o'clock and 4 o'clock on Wednesday. Wednesday, March 19th. It will be a bloodbath if they say anything about this. If they say anything about that and the market does that, that is the position I was saying when you go short, you press short and you hold on for dear life, because that's the market's worst fears. The reason why we went up is because, I guess throughout 2024 was because we had proper GDP growth, inflation was going down, and we had a soft landing in sight. If you listen to every single FOMC meeting like you're supposed to, if you're actively day trading, you know that they've been saying about a soft landing for the past 2 years and how it's one of their objectives and how it's very elusive but possible. And if they say they cannot get this soft landing, there will be a bloodbath that we haven't seen yet. Asset prices will fall through the floor. This current drop will continue, which is going to go into my next video about comparing the bear markets of our past decade, which is 2022, 2018, and our current one, how they differ and how the potential recession could happen if the soft landing actually doesn't exist, because that's what it is. You ask what a soft landing is, it means without any sort of significant economic distress regarding extreme fiscal policies that are supposed to constrict the economy, which constriction needs a lack of growth or even negative growth. That's what a soft landing is. A not soft landing is constriction, but it actually does much worse in constricting, but it stops inflation, because inflation is the worst thing ever. Go ask Venezuela. It's important to know this. You have to know this stuff. You have to if you're day trading. I mean, it's also really important to know, just as a general basis, you need to know when to save your money when there's a potential recession coming, and don't make any sort of crazy brass purchases that you cannot afford or do anything crazy. Just do what you can. It's important to know this stuff, which is why, I mean, if you've listened to 28 minutes of me ramble, it's why you're here. I'll timestamp this so people can actually get to the FOMC if you're interested in it. But, yeah. But by the time I uploaded this, maybe my other video will be uploaded about comparing the bear markets and just seeing how percent drops are confluent with what we've seen here. So, if you watched 28 minutes and 50 seconds of me rambling, thank you very much. Good night.